Hello and welcome to Pension 101, Understanding Your Wise Trust Pension. Today, we will go over these 6 areas to give you a broad, high-level overview of your pension. We'll talk about who can join our plan and what a defined pension plan is, the contributions you make to the plan, how your pension is calculated, and how you earn pensionable service. We'll also cover retirement and some other life and career events that impact pensions and highlight some great features of our plan, such as indexation and survivor benefits. We'll end with providing you some helpful tips and resources where you can get additional information. But let's start with who is Wise Trust. The Wise Trust came together a few years back through the jointly sponsored pension plan arrangement together with WSIB and OCU, and we administer the WSIB Employees Pension Plan, which consists of over 10,000 active, deferred, and retired employees that are all members of this pension plan. The members of our plan include employees from our 6 participating employers, the WSIB, Wise Trust, and our 4 health and safety associations who are Infrastructure Health and Safety Association, Workplace Safety and Prevention Services, Workplace Safety North, and the Public Services Health and Safety Association. Who is eligible to join the Wise Trust pension plan? Membership in our plan is mandatory for permanent employees. Permanent employees are automatically enrolled into the plan on their date of hire. If you are a temporary employee hired on a contract basis, joining the plan is optional, where you may elect to join the plan after 24 months of continuous employment. Since joining is not mandatory for temporary employees, enrollment is not automatic. So approximately 6 months prior to your eligibility date, our Wise Trust Pension Contact Center will send you an enrollment package in the mail. You will need to complete, sign, and return this form before your eligibility date. Regardless of whether you're a permanent or a temporary employee, once you become a member of the plan, membership continues for as long as you remain an employee of a participating employer. And once you're enrolled, you'll receive a welcome package in the mail. The package includes the pension plan guide booklet that outlines important details of the plan and our spousal declaration and beneficiary designation form where you designate your pension beneficiaries. It is important that you complete this form and return it back to us as soon as possible. You will also receive an email delivered to your work email address inviting you to register for My Pension resource, where you can view your personalized pension information and access self-serve pension tools. If you have been hired recently and have not yet received your welcome package, please contact the Wise Trust Pension Contact Center. We will share the contact information with you at the end of this presentation. The Wise Trust Plan is a defined benefit pension plan. A defined benefit or DB pension plan is a retirement plan where the pension at retirement is defined, meaning it's determined or calculated by using a formula that's set out in the plan terms and considers several factors such as length of employment and salary history. You don't have to worry about investment decisions or fees or base your retirement plan around market performance. And once you retire, you'll receive monthly pension payments for the rest of your life. You have the security of knowing that you won't outlive your pension. Our plan also provides survivor and inflation protection. We can get into these details a little bit later on in this presentation. To understand what a defined benefit pension plan is, it's often helpful to compare it with other common employer provided plans that you typically hear about, such as a defined contribution pension plan. As the name suggests, a defined contribution or DC plan defines both the employee and the employer contribution amounts that are paid into an individual employee account. In a DC plan, it's the employee who decides how to invest the funds into the individual account, where the pension income at retirement is based on the amount that has accumulated over time. The pension you end up with is based entirely on how much was contributed and how much investment income was earned, where the employee bears all of the investment risks and rewards. In a DB plan, on the other hand, contributions are paid into a pension fund, which is managed by investment professionals. The pension is calculated by a formula, not the individual's accumulated account balance. And since the pension is defined by the plan's formula, you're able to better predict or estimate in advance what your monthly pension will be when you retire, and the pension is payable for your lifetime. So there's no risks that you'll outlive your savings in a defined benefit plan. Now we'll provide an overview of the contributions you make to the plan, how your pension is calculated, and how you build up your pension. As soon as you're enrolled in the plan, both you and your employer makes contributions to help build a secure financial future through your Wise Trust pension. You contribute a percentage of your pensionable earnings based on a set formula, and these contributions are deducted from your biweekly pay. They are also tax deductible. As of July 1, 2020, member contribution rates are gradually increasing by 0.6% of pensionable earnings per year until the funding for the plan reaches a 50-50 employer-member cost-sharing ratio. Currently, member contributions are approximately 8.2% of pensionable earnings. In July 2024, this rate will increase by 0.6%. You can find more information about contributions on our website, wisetrust.ca, including the contribution formula and annual contribution rates. Employer contributions, on the other hand, are determined by actuarial valuations in accordance with legislative requirements. These valuations are prepared by our external actuary each year to monitor the funded status of our plan. They establish the contribution requirements when the valuation is filed with the regulators at least once every 3 years. Essentially, employers pay for the balance of the cost until equal sharing is reached. Currently, the employer contribution rate is approximately $2.34 for every dollar contributed by a member. This means that for you, every dollar that you contribute to the plan, your employer is contributing $2.34 on your behalf at this time. Your lifetime pension is calculated by a plan formula shown here, which uses two main components, your pensionable service and your best average earnings. Your best average earnings is based on your highest average pensionable earnings over any consecutive 60 months or 5-year period during your last 120 months or 10-year period before you retire. Pensionable earnings is essentially your base pay, so it does not include things such as overtime pay, pay in lieu of benefits, or performance bonuses. For a complete list of what's not included in pensionable earnings, please visit our website, wisetrust.ca. Your pensionable service is the total years, months, and days of service during which you or your employer on your behalf contributes to the plan and can include any eligible periods of service that you've purchased or transferred in from another pension plan, or periods that you are receiving short-term or long-term disability benefits from your employer's disability plan, where you or your employer contributes to the plan for those periods, or periods that you are in receipt of benefits from a WSIB claim, again, where you contribute to the plan for that period. And the more pensionable service you have, the higher your pension will be. If you have part-time service, your pensionable service during that period is calculated as a proportion of the pensionable service that a full-time equivalent employee would earn. Now that you understand what pensionable service is and its importance in determining the amount of your pension benefit, we'll talk about how you can get more out of it. During your career, there may be times when you take a leave of absence, such as a maternity leave or a leave due to illness. Or there may be a time when you've worked for a participating employer but weren't a member of the plan at that time. As a result, there could be gaps in your pensionable service. Purchasing those periods is a way to increase your pension at retirement. The cost to purchase depends on the type of pensionable service and when you're purchasing it. You can find more details on the cost method by the type of leave of absence on our website. But it's important to note that the longer you wait, the more expensive the purchase may be. Requests for a quote to purchase a period of pensionable service can be initiated through My Pension Resource. There are many types of pensionable service that you can purchase, and here's a list of some of them. Temporary service, unpaid absence due to illness or disability, educational or special purposes, including personal unpaid leaves, leaves of absence under the Employment Standards Act, or ESA, including pregnancy and parental leave, and unpaid absence due to a layoff or strike. As mentioned, if you have any of these gaps in pensionable service, you can log into My Pension Resource to view the periods available for you to purchase and request an estimate of the cost. It's important to note that you can only make a purchase when you are an active member of the plan. Once you submit your retirement or leave your employer, the option to purchase pensionable service is no longer available to you, so it's a good idea to check now and see if you have any periods that are available for purchase and get an estimate of the cost. And remember, in most cases, the longer you wait, the more expensive it may be. You may have worked somewhere else where you were earning a pension under a former employer's pension plan. In that case, you may be able to transfer the value of your pension earned in the former employer's plan into our plan. And by doing this, you increase the overall value of your pension at retirement. There are strict deadlines involved in this transfer process. You must make your request to transfer your pension value within 6 months of joining our plan and within 18 months of leaving your former employer. You can contact our Pension Contact Center for more details if you're eligible. The transfer process is a complex one, so please be prepared as it can take up to 1 year to complete the transfer. This is because there is a lot of correspondence that happens between both pension plans and the administrators. Next, we'll review a few life and career events that may affect your pension, such as relationship changes, taking time off of work, or leaving your employer. Maybe you're getting married or entering into a common law relationship, or maybe you just have a few questions about what happens to your pension during a separation or divorce. If your relationship status changes and you need to update your personal information or have questions, please call the Wise Trust Pension Contact Center. Forms to update your spousal status and designate your beneficiary under the pension plan can be found on My Pension Resource. You should name a beneficiary and review your designations whenever your personal circumstances change. Your eligible spouse, as defined under the plan, will automatically receive survivor benefits when you pass away. We'll talk in more detail about survivor benefits and who qualifies as an eligible spouse later on in this presentation. If your spousal relationship ends, your pension benefit may be affected. Under the Ontario Family Law Act, pension benefits earned during your relationship may be included in the division of family property. What this means for you will depend on your own particular circumstance. Before you divide your property, to start, you'll need to know the value of the pension assets that you've accumulated during your relationship. This is done by applying for a statement of family law value. We recommend you get professional financial and legal advice before making any decisions about your pension. Please contact the Wise Trust Pension Contact Center for more information. You may need to take time away from work because of family, health, or other circumstances. If you're away from work and receiving benefits from your employer's short-term disability plan that are paid to you through your employer's payroll, contributions to the plan will be automatically deducted from those pensionable earnings. This means that you will continue to earn pensionable service. Please note, not all of our employers pay short-term disability benefits directly to their employees through their own payroll. You may receive these benefits from an insurance carrier. In that case, you may instead be eligible to purchase those short-term disability periods when you return to work by contacting the Wise Trust Pension Contact Center or by visiting My Pension Resource. For more information on your employer's short-term disability plan benefits, please reach out to your HR department if needed. If you're receiving long-term disability benefits, your employer makes contributions to the plan on your behalf. You continue to earn pensionable service even though you're not actively at work until you retire, reach age 65, or pass away, whichever occurs first. This only applies if your employer maintains a long-term disability plan. Another change that might happen in your life is a career change. When your employment with a participating employer ends, your active membership in the plan also ends. At this point, you'll need to decide what to do with your pension benefit. If you are not yet eligible for an immediate pension from the plan and you're under the age of 55, you'll have three options upon termination. Option 1, you can choose to defer your pension, meaning you can leave your pension in the plan until you become eligible to start receiving it, which can be as early as age 55, but no later than age 65. Leaving your pension benefit in the plan allows you to continue to have predictable lifetime income when you're ready to retire. You also have the option to transfer your pension value into another pension plan if you leave to go to another employer who has a pension plan and is willing to accept the transfer. In that case, you will need to contact the plan's administrator for more details. The third option allows you to transfer the value of your pension into a locked-in retirement arrangement where you're responsible for investing the funds and taking on the investment risks and any associated management fees. If you choose this option, you are giving up your right to a guaranteed monthly pension from our plan that's payable for your lifetime and other plan benefits such as indexation and survivor benefits. It's also important to note that these funds are locked in, meaning the value of your benefit is not available to you as an immediate cash payment. The funds must be transferred to a locked-in retirement savings vehicle that is intended to provide you with retirement income. However, the Income Tax Act does limit amounts that can be transferred into a registered vehicle, so there may be a portion of your benefit upon transfer that is in excess of the maximum limit, which will be paid to you in cash, subject to withholding tax. This cash payment will be included in your taxable income for that year. Since leaving your employer may be an important component of your financial future, we strongly recommend that you seek independent, unbiased advice from a qualified financial advisor who will act in your best interest. We also have some helpful information on our website, wisetrust.ca, that can support you and your advisor in this decision. Please note that if you've reached age 55 or you're eligible for an immediate unreduced pension under the plan's 85 factor at the time that you terminate your employment, option 3 from the previous slide, transferring your value of your pension into a locked-in account, is not available to you. You must leave your pension in the Wise Trust plan and you'll be given the choice to either start it immediately or defer it to a later date. You will also be given the option to transfer it to another pension plan under a reciprocal transfer agreement if applicable.
When can you retire? Choosing when to retire is an important decision, one that can have an impact on the amount of pension you'll receive. The right time to retire will not be the same for everyone. What will be similar for everyone is planning ahead and knowing when the ideal time to retire is for you. Your Wise Trust pension is only one piece of the puzzle. Government benefits, other retirement savings, and lifestyle choices, for example, also need to be considered. But let's take a closer look at your options under the plan. The plan provides you with a number of retirement options: an unreduced pension on or after normal retirement, which is at age 65, an unreduced early retirement pension once you've reached the plan's factors 85 or the 60/20 rule, and a reduced retirement pension that can start as early as age 55. Let's review each of these in detail. The normal retirement date under the plan is the first day of the month following age 65, which means you're eligible to receive an unreduced lifetime pension that's calculated in accordance with the plan formula that we talked about earlier. If you continue to be actively employed beyond age 65 and make the required contributions to the plan, you will continue to accrue pensionable service up until you do retire, or if earlier, to the end of the year in which you turn age 71 when you're required to start receiving your pension. You can choose to retire earlier than age 65 without any reduction to your lifetime pension if you qualify under one of the plan's unreduced early retirement rules, also known as your unreduced early retirement date. We refer to these rules as Factor 85 or the 60/20 rule. Factor 85 is when your age, when added to your years of membership or pensionable service, equals at least 85 points. For example, you can retire as early as age 53 if you have 32 years of pensionable service. The 60/20 rule is when you're at least 60 years old and you have at least 20 years of membership or pensionable service in the plan. Something important to note here is that, similar to your normal retirement date, if you choose not to retire on your unreduced retirement date, which is either Factor 85 or the 60/20 rule, and you remain actively employed where you continue to make contributions to the Wise Trust plan, you will continue to accrue pensionable service up to the date you choose to retire, or if earlier, to the end of the year in which you turn age 71 when you're required to start receiving your pension. If you do not qualify for an unreduced pension under the Factor 85 or 60/20 rule, you can still retire anytime after age 55. However, your lifetime pension accrued to that date will be reduced by 3% for each year that you retire prior to the date you would have qualified for an unreduced early retirement or turned age 65, whichever is earlier. This is to reflect the fact that you're starting your pension earlier and will receive it for a longer period of time. For example, if you retired 2 years prior to your unreduced retirement date, your lifetime pension would be reduced by 6%. That's 2 years at 3% each, which represents 94% of your pension. This reduction is made to reflect the fact that you are receiving your monthly pension payments 2 years earlier. If you retire before age 65, you will receive an additional top-up payment from the Wise Trust plan, which is called the Bridge Benefit. The plan's Bridge Benefit is intended to temporarily supplement your retirement income up until the age of 65, when at that time you are eligible to receive the unreduced pension benefit from CPP or the Canada Pension Plan. Something additional to note here is that even if you begin to collect CPP before age 65, you are still eligible to receive the bridge benefit from our plan if you retire early. But the bridge benefit will only be paid up until the age of 65. CPP benefits and benefits paid from our plan are completely separate. To illustrate, if you retire early, before age 65, you will have two parts to your pension paid from the plan: your lifetime pension and the bridge benefit, as you see on this slide. As an example, if you decide to retire early, let's say at age 58, your lifetime pension and the bridge benefit will both start on your early retirement date. They will both continue until you turn 65, which at this point, the bridge benefit will stop. Your lifetime pension will then continue to be paid for the rest of your life. And if you retire after age 65, there is no bridge benefit payable. When you retire, the negative impact of inflation on your pension will be partially offset by the plan's inflation protection, which will help your pension retain its purchasing power while the prices of goods and services increase over time. Once you retire, every January 1st, your pension will be inflation adjusted, or what we refer to as indexed, based on a formula set out in the plan. Here's the plan's rules or formula for indexation. You'll notice that different indexing rates apply to pension benefits earned up to July 1st, 2025, and after that date. The lifetime portion of your pension accrued up to July 1, 2025 is automatically increased each year by 75% of the percent change in the Consumer Price Index, or the CPI, and the bridge benefit portion of the pension received up to age 65 is not indexed. For the pension accrued after July 1st, 2025, both the lifetime and bridge pensions are automatically increased by 50% of the percent change in CPI, and depending on the funded status of the plan, additional increases above the 50% may be granted in accordance with the funding policy. Each year in December, just prior to January 1st increase, we advise retired members what the increase will be.
Next, we'll talk about another important feature of the plan, which is survivor benefits. Survivor benefits help protect your loved ones financially when you pass away. The type and amount of survivor benefits provided under the pension plan depends on whether you have an eligible spouse, as defined by the pension plan, or eligible children, and whether you've retired and started to receive a pension from the plan. First, let's take a look at the three types of survivor beneficiaries under the pension plan who qualifies under each one. The first is an eligible spouse. Under the plan, this is defined as a person you are married to, or if you're not married, it's a person you have been living and continuously for the last 3 years, or less if you're the parents of a child. An eligible spouse takes priority to survivor benefits over any other survivor beneficiary upon the member's passing. However, if on the date of death the member has an eligible spouse that is living separate and apart from the member, the separated spouse does not have an entitlement to survivor benefits. The second type of survivor beneficiary under the pension plan is an eligible child. This is someone who is either a child under the age of 18 or a child 18 years of age or older, but less than age 25 and attending full-time school, or a child 18 years or older who has a physical or mental disability that prevents them from earning a living. And the third is a designated beneficiary, or more than one beneficiary who may be eligible for the benefits under the plan. A beneficiary can be a person, such as a child, or an organization, such as a charity. If you choose to name multiple beneficiaries, any death benefits payable to a beneficiary will be divided equally amongst your beneficiaries. It's not necessary to name your spouse as your designated beneficiary, since under the pension plan, your eligible spouse, as defined under the plan, will automatically receive the survivor benefit. If you don't have a spouse or your spouse waives their right to survivor benefits under the plan,
and you don't have any dependent children at the time, your designated beneficiary is next in line for the death benefits. If you don't designate a beneficiary or your beneficiary passes before you, any benefits payable when you pass away will go to your estate. This is why it is so important that you review your pension spousal status and beneficiary designation on a regular basis and update them as necessary to ensure we have the accurate designation on file for you. Please keep in mind that your beneficiary designation under the pension plan is separate and apart from other beneficiary designation. For example, your designated beneficiary under your employer's group life insurance plan is different than your designated beneficiary under the pension plan and only applies to survivor benefits payable from the pension plan. You must complete separate beneficiary designation form for the pension and group life insurance purposes. Each form is different and provided by separate administrators of each benefit. Later in the presentation, we'll show you where to review the pension beneficiaries you have on file and how to obtain the pension spousal declaration and beneficiary designation form to make changes. When you make a change, it's important to review your designation under all other benefit plans as well. Contact the administrator of those benefits to make changes. And also, we would like to note that once you have completed the pension spousal declaration and beneficiary designation form, please retain a copy for your records. So what happens if you pass away after you retire and have an eligible spouse or eligible children? Your eligible spouse, who is the spouse at the time your pension started, will automatically receive a spousal pension equals to 66.66% of your lifetime pension you were receiving, and that percent amount will continue for their lifetime in the event of your passing. If a bridge benefit is being paid to you at that time, the bridge benefit will not continue to your spouse, as the bridge benefits are only paid for your lifetime. At the time of your retirement, you will be given an option to choose a higher survivor benefit to continue for your eligible spouse at either 75% or 100% of your lifetime pension. In that case, there will be a slight reduction to your lifetime benefit in order to provide the higher survivor pension. The reduction will not be reversed if your spouse passes away first. And just to reiterate, it is your eligible spouse at retirement who remains entitled to the survivor pension payable upon your passing if you later divorce, separate from your common law spouse, or remarry. If you also have eligible children, your eligible children may each receive a pension up to 10% of your lifetime pension for as long as they remain eligible children, which is until the age of 18, or if they are attending full-time school to the age of 25, or if they have a physical or mental disability that has prevented them from earning a living. If you don't have an eligible spouse but do have eligible children, your eligible children will receive a pension equal to 66 and 2/3% of your lifetime pension you are receiving, divided equally among them, and again for as long as you remain eligible children. If you don't have an eligible spouse or any eligible children, your pension will not continue as it is only paid for your lifetime. However, if the contributions that you made to the plan plus interest are greater than the total pension payment you received in retirement prior to your passing, a payment of the excess amount will be made to your beneficiary. Or if no beneficiary is named, the payment will be made to your estate. You may be wondering what happens to the pension benefit you earn if you pass away before you start your pension. In that event, your eligible spouse will have the option to choose either an immediate or deferred monthly pension or take a lump sum commuted value of your pension which can be transferred to their personal RRSP. If your eligible spouse chooses the immediate or deferred monthly pension and you also have eligible children, your eligible children may be entitled to each receive a pension up to 10% of your lifetime pension for as long as they remain eligible children. If you do not have an eligible spouse, but you do have eligible children, your eligible children will receive a pension equal to 66 2/3 of your lifetime pension that you earn, divided equally for as long as you remain eligible children. If you don't have an eligible spouse or any eligible children, the value of your pension will be paid directly to your designated beneficiary. Or if no beneficiary is designated, the payment will be made to your estate.
To wrap up our presentation, we'd like to leave you with some helpful reminders and resources where you can get additional pension information. There are 3 key reminders that we would like you to take special note of. First, always remember to keep your personal information, such as your mailing address and phone number, updated through your employer. This information is sent to us by your employer to ensure that you receive important pension-related information. If in the future you no longer work for one of our participating employers but have a benefit in the plan, it's important that you contact us directly with any changes to your contact information. Second, we can't stress enough how important it is to keep your spousal and beneficiary information up to date. Please review your designations on a regular basis and update information accordingly. You can view your current pension designations online under the profile section on My Pension Resource. Again, these beneficiary designations are strictly for pension purposes and relate to your pension benefits only. They are not related to any life insurance that may be offered through your employer. Please contact the administrators of those benefits to update your designated beneficiaries under those plans. And finally, when planning for your retirement, we strongly recommend getting qualified, unbiased advice to help with your overall retirement plan. A qualified financial advisor can help you determine how much retirement income you'll need from all sources, including the plan, CPP, OAS, and your other retirement savings to help meet your retirement needs and goals. You can also use the projection tools on My Pension Resource to get a better idea of how much you can expect to receive from the Wise Trust plan and when. These estimates are helpful inputs in making sure your retirement planning is on track. In addition to all of the pension plan related information that you'll find on our website, My Pension Resource is your one-stop shop to your personalized pension information and self-serve tools that are available to all of our members at any stage of their career and even after retirement. My Pension Resource is easily accessed through our wisetrust.ca website by clicking on the login button located on the top right corner of the homepage. You can estimate what your monthly pension benefit will be at various ages or retirement dates and do side-by-side comparisons of the impact on your pension amount under those different retirement scenarios. You can also view your personal account, including your address and phone number on file, and your pension spousal status and designated beneficiaries. You can also request to purchase pensionable service here, view and download your latest annual pension statement, send and receive secure messages to and from our contact center, and even initiate your retirement. Once you retire, the site allows you to manage and update your personal account information, including your banking information. If you already haven't done so, here's how you can register for My Pension Resource. It just takes 5 easy steps. First, go on to wisetrust.ca and click on My Pension Resource in the top corner. Click on the Register Here link, as you can see here just below the login button. Then you can enter in your ID, last name, and date of birth, and follow the instructions to create your username, password, and security questions. And for enhanced security protection, you will be asked to provide an email address and phone number for multi-factor authentication. Once you've logged into the site, you'll see along the top banner that there are 4 main pages or areas on the site: the home page, the pension page, messages, and the profile page. The profile page is where you can view the information that we have on file for you, including your designated pension beneficiaries. And by clicking on the messages page, you'll be able to communicate with our contact center team by sending and receiving secure messages. The My Pension page houses the main self-service features, which are shown here on the left side, and it includes things such as running pension estimates, initiating retirement, viewing periods of service that are available for purchasing, and much more. Something important to note here when using the pension estimate tool or when viewing any benefit-related communication from us is that the amounts displayed are the estimated gross monthly pension amounts and are not the net amounts that's less income tax withholding. Your pension from the plan is considered taxable income like most other sources of retirement income. If you're interested in estimating the tax that would be deducted from your monthly pension benefit, you can find a calculator tool on the canada.ca website. And on the right side here, it shows the resources that are available to you. Here, you'll find your latest annual pension statement and commonly used forms such as the spousal declaration and beneficiary designation form. To make changes to your pension beneficiaries, you'll need to download this form, complete it, and send it back into the Wise Trust Pension Contact Center. Here is our contact information. You can call or send a secure message to our contact center through My Pension Resource. The Wise Trust Pension Contact Center can also be reached at 1-855-242-1526, and they are available Monday to Friday from 8:30 a.m. until 4:30 p.m. Please make sure to have your 5-digit employee or pension ID handy when you do call in. And that concludes our presentation for today.